most of the statistics that have come out recently, that they were taken, or the measurements were taken pre-regional bank crisis. So I'm not sure we should pay too much attention to them. The positive ones were on housing, and I think it's because mortgage rates have come down since the long-term Treasury bond yield peaked last October at 4.3%. Finally, mortgage rates started to come down. So housing starts, permits, mortgage applications, existing home sales, and pending home sales all have done a little better. I mean, housing by many measures was down 40% year over year. So I suppose we shouldn't be surprised to see some rebound there. Autos they're still in recession territory at 14.82, but they came in a little better than expected. But other than that, even before the crisis, a lot of indicators were starting to signal trouble. So employment indicators like job openings have come down fairly dramatically. They peaked at 12 million at one point. Now we're down to 9.9. The Challenger Job Survey of layoffs, which are the larger layoffs, that's up more than 400% year over year. And maybe the most important indicator is initial claims, which were revised recently. And at turning points, as I've mentioned on this webinar before, at turning points, we see massive revisions. Well, such was the case with initial unemployment insurance claims, and that's a weekly indicator. So we have some of those since the crisis, and the revisions are up 25%. 25% in an indicator that the Fed's really paying a lot of attention to, and so are the financial markets. So that was kind of interesting. And then if you look at the various regional Fed indices, they're all disappointing. So the Philly Fed, the Dallas, Richmond, and so forth. Non-defense capital goods orders and shipments, both disappointing and turning down. And today we got retail sales. They were down 1% month to month. That's not a year over year number. Which was much worse than the 0.5% decline expected. But here we have to come back to seasonal factors, and they are all messed up, I think, because of weather. So you'll remember in January, we got a huge increase in retail sales, 3.1%. Now it just seems to be normalizing. So in real terms, we think consumption looks about flat for the first quarter. So not doing too well, not falling off a cliff, but there is some equivocation there, and there was even before the crisis. Then we have inflation indicators, and those are all starting to look very good. CPI up 0.1% for March, still up 5% on a year-over-year basis, and that's what those on the Fed are looking at. Big, long lags. We just got a 0.1. That's 1.2% or so at an annual rate. That's below their 2%. Core CPI was up 0.4. That was a little higher than expected and is still up 5.6. But from there, you see in the pipeline, inflation is disappearing kind of rapidly. The PPI, Producer Price Index, this is upstream, and it will feed downstream into the Consumer Price Index, down 0.5% for the month of March, up 2.7% year over year. Okay, now we have a two handle. 2% is what the Fed is looking for, and that's down in 1 month's time from 4.9% on a year over year basis. So more than a 2 percentage point drop from 4.9% to 2.7% on a year-over-year basis. Even core inflation, PPI inflation, so core means excluding the volatile food and energy, down 0.1% and up 3.4% on a year-over-year basis, down more than 1 percentage point from the 4.8% the previous month. And then even further upstream, which is import prices, down 0.6% in March and down negative 4.6% year over year. So I've been saying for quite some time that we believe the greater risk out there is not inflation, but deflation. And the pipeline is starting to fill up with deflationary indicators.